We've got Vikash Kumar Jain joining in from CLSA. Vikash, hi. Good morning. Just going through your strategy notes, sentiment is excessively bearish. Is the light at the end of the tunnel anywhere close, or it's a long tunnel, Vikash? Because everyone just wants to know when is the poison going to get out of the system, how soon?
Well, I mean, we are no soothsayers, but all that we can do is try and see where we stand versus previous instances of fear. And that's what this index tries to do. So this is our proprietary India Bull Bear Index, where we try to measure investor sentiment. See, when we talk about investor sentiment, generally people think about it more anecdotally on what they're hearing, and what people are doing. But what we try to do with this index is try and quantify it, and using certain matrices which allow us to do it. And putting an historical perspective, we are right now at what we would want to call as 92% bearish reading. And when we look at this thing versus history, typically, somewhere around 90 and 95%, if we work with a 95% bearish reading, it has a reasonable track record. When does the index not work? If we are in a very deep free fall bear market, like say 2008 or the 2020 correction, then a 3-month return may not be necessarily positive. But in most other normal kind of pullbacks and corrections, it has worked pretty well. It has a reasonably good track record when you look at a 1-year return. I mean, a median return of about 17-18% after you hit 95%. With just about a 90% accuracy in the last 9 instances that we saw. So a reasonable track record. So yes, from a perspective of sentiment, we are reaching a point where historically we've had reasonable rallies.
And what is the basis of this? Because when you are saying historically from these levels, we have seen reasonable rallies. But in last 10 years, the world was different. Every time there was an issue in the world, Fed came out to rescue you. Inflation readings were very different. So is it a good idea to look at history and say that what history tells us is an indication of future?
So isn't the world different every time? I mean, I don't think we've ever had a demonetization till we had one. We've never had a pandemic, at least in our lifetimes, till we had one. We never had a GFC. Yes, you can say the Fed is not acting in the side of the market. But I think a lot of these episodes which we've had in the last 15 years are unique. I mean, at least most of our lifetimes over the last 30, 40 years, we wouldn't have seen many of these. So it's always, that's the other side of the argument. But anyways, I won't fight that. All that I will say is that historically, this is how sentiment has worked. Now, this is not really valuation, this is sentiment. And typically, I would say that in all of the historical instances also, fear would have been there. And this is trying to measure what is the kind of bearishness or fear that is prevalent. So I would say that, yes, I think if you imagine of certain things, this is largely right now a financial crisis. It's very different from, say, a demon thing, which was for every person, every individual, every household, or a pandemic, which was hurting everybody. So, there was a time in the pandemic when we thought that we don't have any history to this. So yes, there is. Always you can argue the other side, but I won't get into that argument, I would say.
What is the right way of looking at sentiment? Because the basic benchmark of looking at sentiment is that when the retail folks, they panic, not institutional folks. Right now, DIs are buying. Right now, PMS, we had few PMS fund managers in the morning, they're saying that they're getting inflows. So my question is that markets historically, you know it, I know it, they bottom out when retail panics. And flows dekh ke to nahi lagta hai.
So, I will tell you, I think this is very, I would say, I won't agree with this that you should just look at retail flows. It's basically so what this does is tries to measure positioning, tries to measure the kind of, what we are just focused on is just looking at domestic flows. In fact, this is what I would want to bring out is if you look at foreign flows and the kind of outflows that we've had, this is by far a record. I mean, you pick and choose your duration, 3 months, 6 months, 9 months, 12 months. We've never had this kind of FII selling. In fact, in certain, when we look at certain other parameters, almost, anywhere between 60% to 2/3 of EM funds are now underweight India. In fact, I clearly agree with you that perhaps the next risk to the market is retail participation, whether through mutual funds or directly, coming down. But at least the foreign selling that we have been able to kind of manage, and despite this kind of selling, market largely outperforming, I would say that we've reached a point that perhaps there could be a time that maybe there is some more selling due to retailers, but soon valuations could become more palatable for foreigners to start returning. I mean, if you look at the last 9 months, in fact, last month, India was by far the least favored market for foreigners. I mean, that's where they sold the most. And last 9 months, again, significant selling. With that, valuations have now come within 5% of historical average levels. That's like 17-year average. I'm not looking 5-year, not looking 10-year. Some more correction, maybe if retail was to kind of give out. I think that's clearly a risk to the market, because most retail money, if you look at, mutual fund inflows, that started largely from July. I mean, that picked up largely from July of last year. All of that money is underwater. They would be making negative returns on that. So with that, there is clearly a risk that retail starts shunning equity markets. And if that leads to some selling, the good thing is what I earlier thought would be very difficult, that foreigners could start kind of smoothing that fall, because they are already significantly underweight India.
All I can say, Vikas, is aapke muh mein ghee shakkar. You want to hear this kind of a reassuring voice when right now everybody is trying to look for the next cube. Now, your analysis, it's a great report, talks about the market sentiment, and historically when the sentiment has reached these bombed out levels, market, they give you a bounce. So I have two follow-up questions, maybe a blend of two. One, what could be the extent of bounce back this time around? And B, what happens to mid and small cap stocks also? Because I'm assuming your analysis is centered around benchmark indices.
Yeah, so, I would say that, in fact, good that you bring that up. So that'll allow me to check my bullishness. So because, when I'm looking at sentiment, I don't want to color myself with what I look at fundamentals and other things that we talk about. When we're discussing it holistically, so what if a rally comes in? How long can that rally go ahead? I think the call of how long, how much we could rally is dependent on what happens to bond yields. I think that's really, we should not forget that we are in largely a macro market. And clearly, for any rally to sustain much higher, whether in simple words, whether it is a bear market rally or it is start of a bull market, I think that's something which will be defined by what happens to yields. What has gone unnoticed by the equity markets is the fact that over the last 2-3 days, yields have corrected by 20 bips. Basically, for any significant rally to happen, some events need to happen which cool off the worst fears on yields increasing or inflation kind of being out of hand. Could be that, maybe some cool off in energy prices could be that event. Maybe the upcoming couple of inflation data points, the Indian data point shows a decline, and we believe that inflation in India has peaked. That's the call of our economist. But if we get to a similar data point in the US also, then markets could start saying that, okay, fine, inflation will come off. Maybe it will take time, but at least central banks are not as behind as what we are currently thinking about. Only then would we start feeling more relaxed about yields, and that is what will allow equity valuations to kind of pick up.
Sure. Vikash, I'm curious to understand why the reintroduction of DLF to your India focus portfolio.
Well, I mean, we will not be stock specific, but generally, we like the real estate cycle. We believe, when we are talking about the other thing about the current market situation is, unlike say 2008, where practically all kinds of various cycles also peaked together, whether there was a real estate cycle, there was an economic cycle, there was an equity market cycle, there was perhaps a debt cycle, everything peaked together. That's not really the case, at least in India right now. I mean, our economic cycle is just about picking up. Globally, I think the commodity cycle I don't think is peaked out. That's my personal opinion. I don't think the real estate cycle has reached, levels which are crazy levels like we saw in 2008. So I think from that perspective, it's more about the equity market cycle which is correcting. And the worst is like we had in GFC or in the 1930s, is when all of these cycles together peak out. I mean, that's really the worst point. I don't think we are in a point like that currently. It's more about the financial worries that we have.
Good morning, Vikash and Anthar also joining in on the conversation. So that's DLF, which has been included in the index. But what I wanted to also see and what's in your report is if we were to see the cash in the market, the 7-day moving average, how that is down from the October 2021 peak. Your report also talks about much lower trading volumes. What does all of this indicate?
Well, I mean, see, people can take various signals out of it. My preference is to look at it. See, typically when a trend is very strong, then that trend continues with rising volumes. That's really something which is the general interpretation, that volumes are a confirmation that we are in that trend. And on the other hand, if the trend is kind of weakening, that's when kind of perhaps people don't want to kind of continue with higher volumes. So possibly, and if you adjust for market cap, we are inching closer to the lowest levels we've seen over the last 10 years in terms of cash volumes. Perhaps this just tells us that maybe this trend isn't that strong. This trend of falling prices isn't that strong anymore. So that's the interpretation that I am drawing out of it, which is perhaps a confirmation of how weak the sentiment is already.
Now, what your report also says is that since 2007, and you were talking about this in Nikunj in the opening comments as well, that since 2007, you've seen 15 instances of this index, the bull-bear index, hitting the bearish zone of 90%. But what is heartening, and as Nikunj said, aapke muh mein ghee shakkar ho, you have noticed that in all these instances, it has given positive returns at least 8 to 9 times. So is that again a moment of ghee shakkar in our mouth?
So I think, basically when we are using any particular indicator, we need to know the limitations of that. And of those 15, 3 or 4 times it was hit during the 2008 crash. Basically, at that point of time, worries were so significant that this sentiment did not stop there. I mean, it did cause some days of sideways action or a little bit of a rally, but then it fell again. So that's the point where it fell clearly. Also, the more recent March 20 correction, 95% kind of a reading was hit, 95% bearish reading was hit around early March. The market bottomed 20 days hence, but that had another 20% correction. So if you are in a waterfall kind of a decline, then, it doesn't really pinpoint the kind of that this is closer to a bottom. It doesn't work that way. But so that's a kind of a call that one has to take before using this indicator. I am of the opinion that we are not in a waterfall decline. There's another report that we did about 4 weeks back or so, 4 or 5 weeks back, where we said that the texture of this correction doesn't really show that it's something which is going to be a 40% kind of a correction. It appears to be a less severe correction, at least in the first. We're already in the 8th month of this correction. That's something which we should not really forget.
In last 1 year, and we'll just for the benefit of our viewers, Vikas, I'm just making this point out that the Nifty has given no returns. And from January 2020, you have a 25% return, which is in last 2.5 years, Nifty, which is an outperforming index, has given you 25% return. That's nothing, frankly, if you ask me. So the bubble, I guess, has got pricked now. That is the point. So Vikas, let's take the conversation forward. The sentiment is bombed out. Good news and good prices, they rarely come together. Right now, everybody is on the same side of the boat, and that is how markets, they bottom out. Typical cycle. But there's also one saying in the market, which is courses remain the same, horses they change. And when you see a bombed out rally like this, the leadership in the market changes. Come in on that aspect.
So, what we need to appreciate is that firstly, right now, for some time, we are going to stay in a largely macro market. So there is a term called synchronicity, and our economists did a good job in looking at when markets are more macro. That is, macro is driving the market as compared to the micro. And I think, at least for the next few months, that might continue to be the case. And what is the single biggest data point, or which is going to determine how financial markets in general will move globally? I think what happens to inflation and what happens to bond yields. What we need to appreciate, and this is where I think blindly using historical average will not work. I think, Nikunj, a point that you were trying to make, but not, I think, with sentiment, but with valuations. Like, for example, if valuations are at levels of 7.5%, 8% yield that we are talking about, then perhaps the right average valuations for the market is about 5-10% lower than where otherwise the 16x P that we see in the historical average valuations. So perhaps somewhere around 15x is the right number. So I would say that what happens to yields will be of supreme importance. With that, what it means is that cost of equity as a concept, which was largely forgotten for the last decade, where money was rather easy, will come back. And that also means that expensive stocks in general, in a macro market, that's the first place that we will be quite wary about. In a rising yield environment, those are the kind of stocks which will not do very well until inflation worries remain at the fore. So clearly, we'd be very careful. You should only make exceptions where you believe that very near-term and strong triggers are there. Otherwise, stay away from stuff which is very, very expensive. A lot of the consumption space in India is still around that, mark. So that's something that we'd want to be quite wary about. The other thing is, in an environment like in India, see, if we look at the cost of funds rising or cost of debt rising on a percentage basis, it isn't as sharp as what it is, say, in developed markets, where you were at 2%. If it rises by 2%, that's like doubling of your cost of debt. That's not something which is happening in India. So from that perspective, still, at least for the more like 12, 15 months, we don't really see much balance sheet concerns for bank. If that is something that you can wrap your head around, then that means that they should be able to benefit from rising margins in general. So I would, and coincidentally, that sector also in general is not an expensive sector. So I would say that stay away from very expensive parts of the market, because that's where I think the whole interest rate environment has changed. And many a times, many of these stocks will take a much longer period for derating. I mean, they will not be outperforming for a long time. So I would say that banks is clearly what we prefer a lot. And, the very expensive names, the kind of names which were doing very well in the last decade, will continue their long process of derating in multiples.
Let's wrap it up with one final question, which is, if I look at the consumer names, on paper, yes, they are expensive. But if I put the other logic, which is that in a bad macro environment, these are the companies which have pricing power. These are the companies who will gain market share. These are the businesses who will remain relevant. So logically, shouldn't we be thinking about them?
Well, I mean, let's try and break down what you call the bad macro environment. The bad macro environment is something which is basically commodity prices are elevated, inflation is a big worry. I think that's something which is not a very comfortable environment, because that's an input cost for some of them. Some of them really need to continue raising prices to even protect margins, number one. Number two is the fact that why we are also in an environment where generally the belief on the core economy sector, because of all the capex linked growth push that we've been seeing, has improved. If that is the case, and what that has done is, if we are back to a period where earnings growth, double-digit earnings growth on the benchmark is something that we are talking about. If Nifty is going to give double-digit earnings growth, and these stocks, on the other hand, would perhaps give below par earnings growth than Nifty and have valuations which are far higher, I don't think that that's really the most attractive place to be in. On the other side, and this is really the excesses of the last decade, and they'll take time to kind of cool off. On the other side, you have these core economy names which were largely forgotten, and they will possibly, their valuations are much more palatable, and that's where growth is really picking up versus what it was. I would say that that's where I would want to be. Like I said, that I don't think that this, if at worst, I believe that this will be a speed bump for an economic cycle which is just starting to pick up in India. So that's where I would like to be positioned.
Okay, great to hear your thoughts as always, Vikash. Glad that you could take time out and join us today.
Thank you. Thanks for having me.
Okay, that's